If you're watching this video, then you are looking for more information on the mortgage, tax, and investment strategy called the Smith Manoeuvre. This is a cash flow strategy that not enough Canadians know about, and I'm going to try my best to break it down here and cover the basics so you can decide if this is the right strategy for you. First, let's address the issue that we're trying to solve. As Canadians, we have very high household debt on average, and a lot of us are carrying sizable mortgages. We experience job security fears, economic uncertainty, questionable pensions and retirement planning, all while paying some of the highest tax rates in the world. We're told to pay off our mortgages quickly while investing our money for retirement, but meeting both of those goals for many is not realistic with the current cost of living. Even if you're putting money away every month, you can apply this strategy to accelerate your financial growth and put you that much further ahead. The Smith Manoeuvre provides a lever that many Canadians can activate to reduce some of this uncertainty and take control of their wealth building while still playing within the boundaries of Canadian tax law. And the best part is, it doesn't require any extra funds or require you to borrow more money to run the strategy. And most big banks have the right structure available, so you can likely keep your mortgage at your existing bank. First, we will briefly cover who the Smith Manoeuvre is for. In short, any Canadian who owns a primary residence with a mortgage can benefit from implementing this strategy. The bigger your mortgage and the higher your tax bracket, the more pronounced the results will be. But as long as you have a mortgage on your primary residence and earn some kind of taxable income, the Smith Manoeuvre will no doubt increase your household's wealth. So, let's dive in. Let's take a look at a quick example to put in perspective exactly what your mortgage is really costing you. To pay off a $600,000 mortgage at a rate of 4% interest over 25 years, it will cost you over $946,000. What's even harder to wrap your head around is, assuming $100,000 personal income, you will have to earn almost $1.38 million of gross income to pay off this mortgage. So what can we actually do to reduce these costs? This is the goal of the Smith Manoeuvre. To understand why the Smith Manoeuvre works, we need to have a quick lesson in Canadian tax law. First, in Canada, our primary residence mortgages are not tax deductible. This means that you are paying the mortgage on your primary residence without getting any tax breaks from the CRA. One of the main goals of the Smith Manoeuvre is to convert your primary residence mortgage from a non-deductible debt to a deductible debt. And here's how it relates to tax law. In the Canadian Income Tax Act, paragraph 20, subsection 1, part C states that any funds borrowed to invest in an asset that has the reasonable expectation of generating income has a tax-deductible interest cost. But what does that actually mean? Let's look at a quick example. You can go to the bank and apply for a traditional investment loan and use those funds to invest in a business or the markets. As long as whatever you're investing in has the expectation to generate income for you through dividends or other periodic payouts, you can deduct the interest cost of the investment loan against the income that you are generating with that investment. For example, if you made $5,000 from the portfolio or business that you invested in, but paid $3,000 in interest on that investment loan, you are actually only paying tax on $2,000 of income. Savvy investors and big corporations use this part of our tax law to their advantage every day with huge success, and the average Canadian homeowner can as well. But the question is, how do we apply that to your mortgage? To understand this, let's take a look at how mortgage payments on most mortgages are structured. Your regular mortgage payment, usually called a principal and interest payment, is just that, part principal and part interest. Every payment that you make on your mortgage goes partially towards interest and partially towards the principal. To get clarity on the application of the tax deductibility principle, we need to explore the mortgage centerpiece of the Smith Manoeuvre, which is the readvanceable mortgage. This mortgage structure combines a regular mortgage with a home equity line of credit as two distinct but connected components. A couple of well-known examples are the Scotia Total Equity Plan, TD FlexLine, or CIBC Power Plan, and almost all big banks have a readvanceable mortgage product that will allow you to properly run the Smith Manoeuvre. With a readvanceable mortgage, the principal contribution of your mortgage payment reduces your mortgage balance, then the home equity line of credit limit increases by the same amount. Essentially, you are gaining access to borrow back the equity you are creating with every principal contribution of every mortgage payment. Now, here's where it gets strategic. The crux of the Smith Manoeuvre is using the mechanics of the readvanceable mortgage to access this newly created equity in order to build an investment portfolio. We've established that with the readvanceable mortgage, each mortgage payment creates additional borrowing room in your home equity line of credit. The next step in the Smith Maneuver is to withdraw from that line of credit and invest those funds. Now let's put this in perspective with the $600,000 mortgage example that we looked at earlier. In this example, your mortgage payment would be about $3,156 per month. When you make your first mortgage payment, about $1,173 of that payment will be going towards principal, reducing your mortgage balance. If you have a readvanceable mortgage set up, you will then have $1,173 of additional borrowing room in the home equity line of credit. You then borrow that $1,173 from the home equity line of credit and invest those funds, and continue to do that every month until the mortgage component is completely replaced with a home equity line of credit balance, which has funded your new investment portfolio. And remember the interest deductibility rules that we established earlier? This means that the interest cost of that entire home equity line of credit is tax deductible because those funds are invested in an income-generating investment portfolio. Every year there will be tax savings, and these savings are applied as a prepayment on your mortgage. This is the Smith Maneuver at its most basic level. But why does this actually make financial sense? Ultimately, you're paying interest on funds that you are borrowing around prime rate or a bit higher, and your average returns may not be that much higher in the market. A common misconception is that it only makes sense if you are earning significantly more on your investments than you're paying in interest on the investment loan. The reason this is partially untrue is due to what is referred to as your marginal tax rate. We all know that in Canada, we pay a high level of income tax. If you're earning $100,000 per year in Ontario, your marginal tax rate is about 31%, which means that for every dollar you earn, 31 cents goes to the CRA. We're also paying our mortgage with our after-tax income, which means that for every dollar of mortgage payment, we actually have to earn $1.45 before tax. The other way to look at it is for every $1.45 we earn, 31% of that goes to the CRA, and we're left with $1 to pay our mortgage. But now let's apply this to the concept of tax-deductible interest, like the kind on your new home equity line of credit. Let's say you're carrying a $100,000 home equity line of credit at 5% interest. Your annual interest cost would be $5,000. But because this is a tax-deductible debt, you get to deduct that interest cost from your personal income, reducing your taxable income from $100,000 to $95,000. And because of your lower taxable income, you are going to be paying less tax to the tune of $1,574, or 31% of the $5,000 interest cost. So you are effectively reducing the interest you're paying on the tax-deductible home equity line of credit by 31%, or whatever your personal marginal tax rate is that year. A simpler way to look at it is your 5% interest HELOC is actually a 3.45% interest HELOC. This is now the benchmark to which you're comparing your gains in the market with your investment portfolio. Now, let's zoom out and see what the results would look like over the course of this mortgage's life after implementing the Smith Maneuver. We've established that every month you make your regular mortgage payment, then reborrow the principal that's been paid down through the home equity line of credit, then invest those reborrowed funds. Over the months and years after implementing the Smith Maneuver, your mortgage is paid down, your home equity line of credit grows with tax-deductible debt, and you grow an investment portfolio. In addition to this shifting layout of your financial picture, you also have increasing income tax refunds due to the growing tax-deductible home equity line of credit. After 1 year, you will have a mortgage balance of about $585,000, a HELOC balance of about $14,000, and an investment portfolio worth about $14,000 as well. If we zoom out, after about 10 years, you'll have a mortgage balance of about $416,000, a HELOC balance of about $183,000, and an investment portfolio now worth about $204,000. After 22.3 years, your mortgage will be completely paid off, and by the end of the 25-year plan, you will have a home equity line of credit balance of $600,000 and an investment portfolio worth just shy of $1 million. In addition to that, you would have received an extra $108,000 in tax savings over the 25 years that are assumed to have been applied as annual prepayments to the mortgage in this scenario, which is the recommended usage for these funds. As a net result, if you look at your investment portfolio compared to your total debt, you are about $395,000 better off than if you didn't implement the Smith Maneuver. So, we've hit our 3 goals. Pay off the mortgage faster by about 2.7 years, increase our tax efficiency by about $108,000, and grow a substantial investment portfolio to supplement your retirement. All of these by intentionally restructuring your mortgage and cash flow to better your family's financial well-being. So how does all of this net out? If we compare these results to what it would look like if we did not implement the Smith Maneuver, this is what the true net apples-to-apples comparison would look like. Without the Smith Maneuver, you would have paid over $346,000 in interest over 25 years and be left with a free and clear home and no additional investments. With the Smith Maneuver, your mortgage would be paid off faster, resulting in almost $30,000 in interest savings. You would have a new investment portfolio worth almost $900,000 after factoring in capital gains, offset by a $600,000 home equity line of credit balance, which results in a tax-free net wealth improvement of $327,000. One very important thing I will point out is that if you look at the interest cost of the regular mortgage way, which is $346,000, and you look at the net wealth improvement of the Smith Maneuver way, which is $327,000, what you've actually done is almost created yourself a free mortgage, because the net wealth improvement of the Smith Maneuver way is only slightly less than the interest you would have paid if you did not implement the Smith Maneuver at all. Once that sinks in, let's move to wrap up the video by talking about how we can get even better results. The structure and cash flow that we just discussed is an example of the Smith Maneuver in its simplest form, but depending on your specific financial situation, we can implement tweaks to add more fuel to your growth, and these are called accelerators. I will go through the accelerators very briefly with the projected results to provide a base level understanding of their effect on the example we've been using in this video. The debt swap. This move involves any savings or investments that you have to increase the power of your Smith Maneuver. Essentially, you would use a lump sum of your existing funds to make a large prepayment on the mortgage and reborrow this to reinvest. The outcome leaves you with the same level of savings or investments, but a head start on converting your non-deductible debt and increasing your tax efficiency immediately. The cash flow diversion. This accelerator involves any income that you are typically saving or investing every month and reroutes it as a prepayment on the mortgage, then reborrowed to invest as normal. Like the debt swap, this does not take away from your savings or investments, just uses funds in a more strategic way every month. The dividend reinvestment plan. This accelerator involves the dividends paid out from any investments that are currently existing or being built through the Smith Maneuver. Instead of having the dividends automatically reinvested, you can route those dividends through your readvanceable mortgage and, well, you guessed it, this also accelerates your debt conversion and tax efficiency. Prime the pump. This is available to homeowners who have some existing equity, as it involves borrowing more from the home equity line of credit to create new debt. This is the only accelerator that involves borrowing more than you already have, and the goal is to use these extra borrowed funds to kickstart your investment portfolio. Cash flow dam. This accelerator is available for homeowners who own a rental property, have a basement rental or laneway suite, or operate a sole proprietorship business. The income from these assets can be used as a prepayment on the mortgage, and these assets all have expenses that can be paid using the home equity line of credit. When it involves income-generating property, it is sometimes called rental cash damming, and in my opinion, is a whole strategy on its own. For anyone who owns a rental property or has a basement unit, this is a must-explore strategy, and I made its own dedicated video linked below. Here you can see the assumptions and results if we were to implement these accelerators along with our base level Smith Maneuver. As you can see, the effects of the accelerators can be quite profound. Feel free to pause here and compare the outcomes. Lastly, I wanted to address some common misconceptions and frequently asked questions about the Smith Maneuver. As addressed earlier in the video, the interest rate on your home equity line of credit actually has a lower nominal rate based on your tax bracket, so beating that nominal rate in the market is easily attainable. The only aspect of the Smith Maneuver that's considered leveraged investing is the prime the pump accelerator, which is completely optional. Every other part of the Smith Maneuver uses funds that you have already borrowed without increasing your debt load. If you do engage the Prime the Pump accelerator, it is important to review this with your investment advisor and consider some enhanced suitability diligence to make sure it is the right move for you. The Smith Maneuver was developed in the 1980s where interest rates were in the double digits. Even if rates are high, the Smith Maneuver still yields positive wealth-building results. Running the numbers using a 10% borrowing rate and an even lower marginal tax rate than our example here, we are still paying the mortgage off early and adding a significant net wealth benefit. No, you cannot invest in your TFSA or RRSP with the borrowed funds, since these are already tax-sheltered investment vehicles with specific treatment from the CRA. You should invest only in non-registered, income-generating assets. The short answer is you can absolutely move homes while implementing the Smith Maneuver. There are some specific considerations around the timing of the sale and the purchase that need to be coordinated properly, but with the help of a Smith Maneuver certified professional, this can easily be achieved. No, the The principle of tax deductibility of interest requires that the investment have the reasonable expectation of generating income, and for the purposes of the Smith Maneuver, cannot be a registered account like an RRSP, TFSA, or RESP. The Smith Maneuver is a powerful strategy, but its compliance with CRA rules depends entirely on how it is set up and executed. A single misstep in the structure of your readvanceable mortgage, the purpose tracking of borrowed funds, or the documentation of your investment income can result in the CRA disallowing your interest deductions, eliminating the primary tax benefit of the entire strategy. A Smith Maneuver certified professional has the specialized training to ensure that your mortgage is structured properly from day one, that your cash flow cycle is properly documented and defensible, running through the right accounts, and that your specific financial situation is accounted for in the implementation, including which accelerators are appropriate for you and which carry risks that you should understand before engaging. In short, this is not a strategy that you want to learn by trial and error on a six-figure mortgage. To cap it off, your mortgage is going to cost you whether you like it or not. The question is, are you going to make your debt work for you so that you can get further ahead? The Smith Maneuver doesn't eliminate the cost of your mortgage, but it helps to minimize our greatest expenses as Canadians: taxes and interest. And over 25 years, that difference is worth hundreds of thousands of dollars. Can you afford to do the Smith Maneuver? Of course. It doesn't cost you anything that you're already paying. The question is, can you afford not to? If you want a customized results analysis based on your personal situation, use the link in the description to book a meeting with me, and we can take a look at your numbers together. Take great care, and thanks for watching.